Good afternoon. My name is Phathokuhle Zondi. I am the Chief Executive Officer of the Sports Science Institutes of South Africa. It gives me great pleasure to welcome you to the second of our series of webinars. Last week, we kicked off with a webinar exploring the impact of COVID-19 on health and healthcare in South Africa. And today, it gives me great pleasure for us to continue this series, specifically speaking to the economic impact of COVID-19 in South Africa. I'm going to ask if you can just give me a second so that I can make sure that I have the correct screen being shared. All right. So as I said, today we steer into the conversation around economics and the economic impact of coronavirus in South Africa, specifically on livelihoods. To help me navigate our way through this conversation, I am joined by Mandla Moyo and John Kennedy. Mandla Moyo is the Chief Financial Officer of the Sports Science Institutes of South Africa. He joined the CISA family in 2018 and has played a critical role over the past 2 years as we've navigated a new role for the Sports Science Institutes of South Africa. He is a director at the Health Foundation of South Africa and also of the National Health Group, excuse the typo. Interestingly, as if he doesn't have enough work to do in South Africa, at the Sports Science Institute of South Africa rather, Mandla is also pursuing a doctorate in public health care. John Kennedy is a director and the regional head of Cape Town at Citadel. I met John 3 years ago, and it's been a privilege to interact with him over the past period. He is well experienced in wealth planning and asset management, having joined the Citadel family specifically in 2001. But what we might love most about John in our family, of course, is that he is a very avid outdoor sportsman and a very proud family man. Just in terms of the conversation that we will delve into today, today, as I said, we're really going to look at the economic impact of COVID-19 in South Africa. Primarily a health concern, the coronavirus, as we know, has had widespread economic consequences. Many individuals find themselves particularly anxious, wondering if they will get a paycheck at the end of the month, if their salary will be impacted as the months progress, and as the impact of coronavirus is more widely felt. Business owners are asking themselves very difficult questions about the viability of their business in the short term, in the near term, and certainly the relevance of their business as, again, the pandemic progresses and consumer behavior starts to change. And as we heard yesterday, governments, our own governments included, are scrutinizing their budgets. They're scrutinizing availability of resources and desperately trying to come up with solutions and answers, balancing the act of lives and, of course, economy. In terms of the conversation that we're going to have today, we are going to start by having a look at the South African landscapes, macroeconomics and the factors and the influences on this. John Kennedy is going to take us through this and also going to take us through what we need to consider for our own personal economy in this really difficult time. He will then hand over to Mandla, who will talk us through the various aspects that you need to be scrutinizing in order to ensure that your business remains agile and viable in the near and long term. And with that, I'd like to invite John Kennedy to take us into the first part of our conversation.
Thank you, Potter, and thank you for those kind words. I hope you can all hear me. I'm going to share my screen shortly. I think we just need to acknowledge that we're living in a world at the moment that has a lot more questions than it has answers, and I will try and address some of them through the course of this presentation. Let's just get this up on your screens. And Mandla, I'm looking at you. Can you give me a thumbs up if you can see that clearly? You can. Fantastic. I have no doubt that all of you that were in the back end of 2019, wherever you were leading into New Year's Eve, were sitting there, hopefully with your families and friends, having a gin and tonic or any other beverage, reflecting on a year of 2019 and thinking probably not a bad year and looking very much forward to 2020. And sitting here now wondering what happened. How on earth did we end up in this point? And, what on earth is going on. And I'm sure you're all avid readers, and you probably have a lot more insight into the medical side than I certainly do. But there is a saying that there are decades when pretty much very little happens, and then there are weeks when decades happen. And I think the last couple of weeks speak to massive change. And the question, I suppose, on many of our sort of lips is that, is this world version 2? You know, are we moving into completely uncharted territory in new times, and there is no playbook to fall back on? Because not long ago, a virus entered our lives, a virus that's something that doesn't recognize borders, trade tariffs, doesn't listen to any president telling it what to do, and moves very quickly across the world and exposes all of our vulnerabilities, and probably more so shows us how integrated we are. And so there's a world that was 2019 and before, which was version sort of before Corona, version BC, and now there's version AC after Corona, and right now we are DC, we're in Corona. And so many of these pictures are familiar to all of you. We were not long ago told that we're now in lockdown. We saw people movements stop abruptly. We saw business movements stop abruptly. We were taught about social distancing all of a sudden. We were taught that sport would disappear. I never in my wildest dreams thought that I would tune into channel 201 on DSTV to try and see what was on sport on Wednesday evening, to have Rocky 3 as the main headline, main item at 8:30 on Wednesday. I just never thought that was possible. But the world is changing, and I'm going to try and interpret a little bit of that by focusing on 3 things. I'm going to take you through the global economy and what's going on. I'm then going to talk to what's going on in South Africa on the economic front, and then I want to talk about your personal economics. And the global economy, I think we just need to acknowledge at the moment that things are so fluid at the moment that the data almost becomes irrelevant as we move on. And so a lot of the data is last year's data, which still has last year in it, and we have 1 or 2 months of the virus impact in it. And so this is very, very fluid. And I'm not going to spend too much time on each graph. I'm just going to show you what each of the sort of different sectors of the world's economy are talking to at the moment. And none of it should be new to you. None of it should seem sort of strange. When we talk about the world, when we look at the globe, it's very important that we just step back just slightly and just remind ourselves what makes up the world and where we should focus our attention to understand where the direction of the global economy may or may not go. In front of you is a ball that represents the Earth, broken up into its different regions, and each region's share of gross domestic product is printed there both as an absolute number in dollars and as a percentage. And if you look at this sort of, if my arrow is showing here, America makes up 24% of the world, China makes up 16% of the world. So between 2 countries, 40% of world gross domestic product is made up. And so it's always important to understand, when we go back to 2018 and 2019, why a trade war between Trump and China was so important, because whatever happened there had a huge residual impact on the rest of the world. And so whatever is happening in those economies currently has a huge impact on the rest of us. Europe makes up a sizable chunk, but is very fragmented across different countries. There you can see the UK makes up 3% of the world, Germany makes up 4%, Japan makes up 5%. And there we are, we're on the ball, we are represented. South Africa makes up just under 0.5% of the world's gross domestic product. So let's start at America. What are American charts telling us at the moment? You know there's been a supply side shock. You know that business has pretty much been shut down across the board, or at least if not shut down, severely disrupted. And the manufacturing index, the Dallas Fed manufacturing index, is showing us a significant plummet in manufacturing over the course of the recent past. Move it across to employment in America. America, from roughly 2009, has had significant expansion, a significant new employment, roughly 200,000 new jobs created every year. This blue line represents unemployment in America. It peaked at 10% in the Great Recession, and now we're seeing it move down to 3.5% until the recent past. The amount of jobless claims in America are unprecedented, and we're seeing the sharp movement up in US unemployment picking up. Shift one step further, what's happening to American companies? You can see that economic expectations, the outlook for the next 6 months, is very negative. That feeds through into earnings, into corporate earnings. If it feeds through into corporate earnings, it feeds through into stock markets. And if anybody's trying to understand why stock markets have come off so significantly in the recent past, between pretty much Valentine's Day, 14 Feb, up until a bottom around the 24th of March, is that when the unknown and so much is uncertain about how much profit could be lost in the current environment, markets react strongly. And if markets react strongly on the downside, people feel poorer in their investments. If they feel poorer in their investments, they spend a lot less. That's all feeding through as we speak. If you look across the pond to the United Kingdom and you ask your average Brit what their view is on the outlook for their economy, it's severely down. And if you ask them about their personal finances, you'll see both of these metrics tell them that their financial situation is a lot more gloomy and their view of the economy is a lot more gloomy. This on top of all the other concerns that they had running up to Brexit and into the negotiations that are still taking place this year. If you look at Europe, move one step further east, you see similar points, sentiment down, big economic impact on sentiment, and these gray bars signal recessions. I'm going to talk to recessions just now, but historically this gray bar represents past recessions over the course of the last 20 years. And you can see when this green line shifts down sharply, a recession seemingly looks like it's around the corner. Talk to global trade down. Should make sense. Volumes are down. You can see by this little circle here that volumes are down. Trade growth has turned negative and expect that to continue at a rapid rate. This is nothing new. We should expect all of this as the world has pretty much gone into lockdown in the recent past. China has an amazing ability to publish their numbers very shortly after a quarter end. They published a number which showed that their economy contracted 6.8%. annualized in Q1 of 2020. Why is it important? Well, China was where the epicenter of the virus started and was the first country and city in Wuhan to react to lockdown and put measures in place to stem it. If this is indicative of what happened in China, one should sort of extrapolate this across the world to varying degrees and say one should expect recession to kick in across the world. There has been some rebound in certain stats and indices coming out of China as the lockdowns have sort of been eased, and you've seen a recovery, but you only have to look at retail sales in China. Chinese people and retail sales in the 12-month movement year-on-year percentage, and you can see it's dramatically down, indicative of a consumer who's probably holding back on a lot of the spending that they would have done in a normal environment. The question that we've been asking for quite some time from a global point of view is the world's been expanding since 2009. The world recovered strongly, in particular led by America, through 2009 all the way into 2019. And a question that we asked ourselves was, how long would this recovery go on for, and whether one would expect a recession at any point in time. And so you might have read in numerous pieces over the course of the last couple of months of 2019 of, would the world see a recession? Well, I can categorically state that any doubt in your mind, the world will see a recession. If it's not now, it will be during the course of this year. And all the characteristics of a recession are what you see in yellow. Confidence drops, economic activity slows, GDP contracts, unemployment increases, wages freeze, certainly in real terms, cash flow gets squeezed, credit tightens. We tighten our belts, things become a lot more liquid, and our mindset and behavior changes. And we're seeing that as we speak. I think we all just sort of can acknowledge that is what we see happening in the broader global economy and certainly in South Africa. And so let's talk to South Africa. And may I just pause for 1 second and say that how grateful I am personally, and I'm sure many of you are, to have Cyril Ramaphosa at the helm. He came into the presidency at the back end of a messy election at the end of 2017 at the ANC conference, came into power in 2018. And if I just look around and look at world leaders, certainly South African leadership has stood its ground. But let's be honest, like us, he is equally a worried man. But he was a worried man before Corona. Because if you looked at South Africa's growth rates over the course of the last 25 years, going back to 1995, the dawn of democracy, for the early parts, you'll see that there's a synchronicity between the orange line, which is our growth rate, and the black line. We moved in tandem with the world. We moved in tandem with the world through the Great Recession of 2008, 2009. But subsequent to that, these crocodile jaws have just opened up in the wrong way. And we all get it. We know it in hindsight. This was the dark decade. This was the decade that was, well, we all know it, you know, corruption, public spending that was wasted, a whole range of things where we just widened this gap up, where our new finance minister, Tito Mboweni, brought aloe ferox. You're all familiar with it when you're in the Eastern Cape. You'll see them on the side of the road. He would bring that to budget meetings. I was fortunate to be in Parliament in October last year where he presented the medium-term budget. And his message to all of us then was, here's a plant that survived and thrived in a very tough, arid type environment. And we needed to gear the South African economy to survive and thrive in what is a tough environment. And unfortunately, Corona and the virus have just amplified that, as we well know. If you look at our consumers, we know we're all under pressure. If you look at retail sales, we know retail sales are under pressure and tracking downwards significantly. And we know that business confidence has been sort of falling for many years and has recently just been pushed down even further. I think we can understand all of that, and I think we just acknowledge it. And why I'm going through these slides rather quickly is that none of this is new. It's not what you haven't seen in the press on the front page of all the financial mediums in the recent past. The Rand, unfortunately, has equally felt the brunt of all of this. A lot of, I just want to touch very briefly on the Rand and just highlight what this chart shows you. The Rand is impacted significantly by events around the world. I showed you the globe earlier. I showed you that South Africa makes up less than 0.5% of the world. The Rand is a very liquid currency, and you should expect it, as its liquidity, as liquid as it is, to be pulled around. The Rand is the blue line here. It is the Rand dollar. The red line here is our emerging market peers, Turkey, Russia, Brazil, India, Indonesia, so on and so forth, and how they do against the US dollar. And you can see there's a certain amount of synchronicity to all of this. It moves out slightly. When you fire a finance minister like we fired in Shlanhlanena, it moves out dramatically, as you can see in 2015. In Ramaphosa, you can see that we all expected our president to deliver probably and hopefully and foolishly a lot sooner than we had, and it strengthened dramatically relative to our peers. But this backlash of risk off around the world, a move out of emerging economies, out of emerging markets, has seen both our peers' currencies weaken dramatically and our currency weaken dramatically. And a discussion on the Rand warrants a lot more time than I have, so I'll move on. Where we find ourselves today, folks, is that we have, as a country, underperformed the rest of the world. Our trend line, this orange dotted line, has underperformed the world significantly for too long. And because we've underperformed the world, we don't have the buffer or the resources that we would want to in a down cycle. A down cycle is normal, but unfortunately, we haven't sort of stocked enough away in the good times, if we had them, to be able to avert what will be a severe and sharp recession through the course of this year. That is reality. It'll be more severe than what we see in the rest of the world, and I suppose we all need to be preparing for it and getting our mindset around it. And I don't want to say embracing it, but instead of running away from it, almost turn around and face it, and I'll touch on that just now. And we should hopefully see a sharp rebound into the course of 2021, and then growth will taper off somewhat to a new trend line, which will be significantly below what we've become accustomed to. None of this really should be new. We cannot expect it to revert back to normal and what we thought it would be. Version 2 is well underway. Are we heading for a depression? Is a question that a lot of people have asked us. We don't think so. If you look at this chart here, it's the US budget deficit relative to their size of their GDP. It goes back all the way to the Great Depression. At no period, this is US fiscal stimulus at the moment, it is north of 15% of their GDP. It is absolutely enormous. At no period, if you cast your minds back, has it ever been higher than World War II. You know, stats are being rewritten at the moment. This is incredible stimulus that is coming through from the US. It's coming through across all regions around the world. Every country is trying to stimulate. Every reserve bank is dropping interest rates. Our own reserve bank have dropped interest rates 2% this year, and we should possibly expect some more if inflation remains subdued. The monetary authorities and the fiscal authorities are doing everything they can to avoid a crisis. And what caused the Great Depression of the 1930s was a form of austerity. And if you look at the stimulus that has come through here, we don't expect it. Those of you watching our president speak earlier this week would have seen something similar. South Africa has also come to the party, so to speak. for government to pick up a lot of the slack that has been created on the consumption and business side of things, and to try and stimulate where they can, and equally to provide support for the poorest of the poor in a time when they don't have the means to ride this out. There's good news. The good news is, and like I said, I'm no medical specialist, our team are watching this closely, but it does seem when one looks at internationally, the round one peak of the virus seems to be happening across the world. The graph on the left, this is taken from the Financial Times, shows a peak in the US of new cases, and you see China probably leads the way, as that's where the virus started. You seemingly see a peak. There are obviously phase 2, round 2 risks, but at the same token, you see the same in the death toll, seemingly looks like it's peaking. And if you look at South African stats, same flattening of the curve now. Looks like it's I don't want to say under control, but round one seemingly has worked. And that's why when we turned on our telly last night and waited for our president, we were all anxiously waiting for what does it mean, not just for lives, but for livelihoods. What decisions would government take to allow us to return to some form of economic activity in what is now seen as a risk-adjusted manner in the course of from next week, 1 May onwards. And so that must give us some hope for the economy to start to sort of grind its way through. It's all well and good for me to talk about the world and what's happening on the global side. What I do need to do is talk about our own personal economics. We as human beings seemingly onboard a lot of anxiety that doesn't necessarily always have impact to us. We allow the noise in the news to distract us. And you know, what we always say to people is focus on your own personal economics. Make it personal and focus on the elements that you can control. And so one of the parts is always to try and get into people's psyche is to expect the unexpected. And we know that that's trite. We know that that doesn't seem, in current times, that's not all that novel. But the truth is the future always does surprise us. It is always murky. There are always events, whether they are macro events or micro events across political, environment, social, and economic. You know, I just went back to find a couple of surprises of things that one didn't anticipate or expect. And it had an impact in a different way on different people. And this is always around each of our corners. There's always something that causes us to worry or disrupt us. Us in Cape Town faced day zero not that long ago, which was a significant potential environment crisis. But if you look across the board, there are crises across businesses, across environmental, across social impacts and politics. This will be an evergreen, that the unexpected will find its way into all of our lives. And so when they do happen, how do we react? Do they distract us? Do they disrupt us? Or do they potentially destroy us? And that answer is different for each and every individual when the question is asked, because whilst you can never predict what's around the corner, you most certainly can prepare. And so our version of preparation is always to say to people, rather than living by default, rather than drifting, live by design. And for design, when we say live by design, we look at a very, very simple framework, which just segments how we allocate our energies and our times, and what hats we wear, acknowledges the hats that we wear, and tries to get people to answer the questions: am I thinking about this as a business operator? Am I thinking about this in terms of my family and the life that I lead? Am I thinking about this as an investor? Is this disrupting me? Is it distracting me? Or is it potentially destroying me? And if you're fortunate enough, what you should also be thinking about is if you're in the position of having enough or wanting to leave some form of legacy, there is something greater than yourself and paying it forward. And I'll probably touch on that a bit later. There are rules to each, and I don't have the chance to go through each of these rules, and we'll send this out potentially as a slide pack. Phathokuhle, you and your team can send it out afterwards. But there are rules to being a successful business operator. And there's rules to hopefully leading a sustainable lifestyle. And there's rules to being a successful investor. And in our experience, a successful business operator, a successful employee in business, we all have the chance, hopefully, to pick a lane or a lead domino that allows us to just concentrate our attention and our resources and make the sacrifices that we need to over a long period of time, where ultimately wealth gets created. And in our families and our lifestyles, never more have I ever seen the fragility of families or health than in the current environment, but historically. It is truly our health and our families that really make us fragile. And when I make the point there that your body has capacity to 95, we've always tried to get people to stretch their minds, to think beyond just 2020 or 2021, but to think into the 2030s and to the 2040s, where the probability is we'll all live there. And the side of the balance sheet that are assets there, to just see them as enjoyment assets and not to have them overgeared, and understand that inevitably they consume our money and they depreciate. And if we're successful investors, we will understand that we should be thinking globally, but live locally and look to secure cash flows and to eliminate gearing and keep it simple. And the last point on this one in particular is just to embrace seasonality, to understand that seasonality is in everything. And just like winter follows autumn and summer, you don't necessarily need to know when it will change, but that spring and summer follows autumn and winter. And so there's always a cycle, there's always an economic cycle. There will always be recessions, there will always be periods of expansion. But from time to time, what ends up happening, as the great philosopher Mike Tyson teaches us, and I'm going to use a few sporting analogies given the audience and the platform that I'm using. The great philosopher Mike Tyson tells us every now and again that we all have a plan until we get punched in the mouth. And it's true. And let's face it, at the moment, we can live by design, we can look at our personal economics, but we're all getting punched in the mouth. And I wasn't sure how to react and how to answer that. But the best way is probably to just remind you what happened in Wimbledon semi-final 2018. Our very own Kevin Anderson was playing against a giant in John Isner, 6'10", with a booming serve. One of the longest semi-finals and matches in tennis history. And they went deep into the fifth set. The games were 24-all. Isner was serving. Anderson was going through a bit of a tough patch. He was exhausted. And then this happened. Never seen before, I suppose, in tennis in the semi-final, a left-handed shot that ultimately was the undoing of Isner and shaking his head afterwards and caused Anderson to sort of take the match. And you know, sometimes we've got to look to internal or external motivations to sometimes just adapt, be agile, be somewhat different, as Anderson did. And I think that's that DC where you see personal economics says economics is what I do during Corona. What can I do? How can I be audacious? How can I be agile? How do I think about things massively differently? And Mandla will probably touch on the business agility side, but I've listed a few things that we should be thinking about at the moment in each of those domains. What we should be doing on our lifestyle is just reflecting and reviewing that where our money goes, reflecting where our expenses go, what is fixed and baked into the cake in terms of fixed costs and our variable expenditures. We should be trying to protect as much cash as we possibly can and defer any capex spend for the time being. We should potentially, if we're under stress, be engaging with medical aid specialists of what we can do on the medical aid side, and also on the risk cover side, with understanding that any change has implications, and I wouldn't not do anything without chatting to the specialists. You may well get a premium and defer a premium on your risk cover, but it may expose you to not being covered over this time period. If you look at business, you should be engaging with your debtors, those people that owe you money, and your creditors who you owe money to, and looking at plans and figuring out ways to make sure that your business can survive, either via business assistance from government or tax breaks that have been given. It certainly is a new world of trying to find alternative income sources or distribution models as the growth in digital and online has shown. And as an investor, if you need to, you can look at deferring retirement fund contributions if you absolutely have to. At the moment, it's never a bad time to buy when market prices are down. So if you can defer not making that decision, I would suggest it. But at the same time, revisit your portfolio and your asset allocation. Look at your cash and liquidity requirements for the next year or two. Make sure that you cover there. And if you're able to see the long term, because you have the capacity to live to 95 and you have the long term in mind, and you should have the long term in mind, stick to the strategy that you follow. There's no point in time in trying to change tack all of a sudden in the eye of the storm. What forces people often to do that is that their emotions override logic, now's the time to just try and put that emotion to bed. And if ever, as I'm about to finish, Phatho, if ever there is a time to pay it forward, I think now is the time where South Africans stand up and be counted. It's an opportunity to give back where one can. I know every single person that I'm doing is trying to do the little bit. Both us as individuals in our business are doing the same, and others at business as well. And we can all hopefully get through this together. So I wish you all well. I'll take your questions a little bit later. And while you can stay home until 1 May, and if you have the opportunity then to get back into the economy, I wish you well. And thank you very much. I'm going to hand over to Mandla now, stop sharing, and hand over to you, Mandla.
Thank you, John, for that talk. Some great life lessons that we can all take away from there. I'm just going to share my screen now so that I can add my slide. If you can give me a second. Right, so I'm going to talk about 4 things. The assumptions that have changed for businesses, which might be a shock to some of us, what the roots of an agile business are, how we deal with uncertainty, and I'll talk a bit about our experience as the Sports Science Institute in coping with the COVID-19 changes. I'm not going to talk about the tax breaks that have been mentioned by the president or the various business assistance programs. I think there's enough material on that on the web for those who need information there. If I can start with the basic assumptions, the first assumption that's really changed is that risk is now at its lowest levels. I'm hoping that's not a shock to people, but it's true. Risk is the potential of a bad thing happening. But now it's happened already. There's been so much noise in the news for the past 3 years that a downgrade is about to happen. The downgrade has happened. Oil is at its lowest price. So the risk of the oil price dropping is low, because a few days ago, oil was almost worth nothing. Similar price to what oil was when it was discovered in 1859. So yeah, risk is very low now. And John mentioned that one may even consider investing in equity at this point because of the low prices. However, the volatility is at its highest levels, and that's what's making it so difficult as business to cope. The president spoke about this 5-stage lockdown process. And the big challenge with that is that you don't know at what stage you'll move to a level 4 or level 3. And also your particular municipality can set a level that differs from the country. And that makes it very difficult for a business to plan ahead. And my view is that perhaps 40% of businesses may never be the same again. However, the comforting thing is that we will get back to 100%. If you look at all the economic cycles, the world has always bounced back. Even from the Great Depression, we will bounce back. The challenge is that some businesses and some employees won't be part of that bounce back. So we need to make sure that we are part of that 100% and we don't get left behind in any way within our businesses. Another assumption that we need to look at is that because the interest rates have dropped so low, the president announced another 200 basis point change, the risk appetite is going to increase. People are holding on to their cash at the moment because they don't know what's happening. But inevitably what's going to happen is that people will start to become bolder in the next few months. Because if you leave your money just sitting in a bank, for example, you might not be earning less return than the inflation rate. And that's what hopefully gets entrepreneurs out there saying, I'm going to take a risk with this project or investment. So yes, the assumptions have changed. Basic economic assumptions still rule, but we don't know about human behavior, and most of us businesses deal with human behavior, and that's a big question mark. Now, if we look at the roots of an agile business, and I'm just envisioning a tree, the top part is obviously the fruits, which is a sum result of the nutrients that the tree gets. The roots of an agile company are really flexibility in financial forecasting. A few months ago, I think many businesses would have started to look at their 3-year business plans. You can throw those business plans out of the door. They're no longer appropriate. What you now need more and more are flexible financial forecasts that look at multiple scenarios. And at CISA, we at one stage we had 3 or 4 scenarios, just trying to picture all the different things that can happen. So the single budget that businesses are used to is increasingly becoming irrelevant. It will come back in due course, but you can't use that for now. We've also seen people doing weekly cash flow stress testing. And stress testing is really something that the banks have always used quite well. And it will have to spread to more and more businesses. And what that looks like is looking at what if scenarios. So what if this customer doesn't pay? Or what if our expenses go up? Or what if we're in level 4 for 2 months and not 1 month? So that's a sort of cash flow planning that one needs in this environment. And at the same time, you need to look at new revenue opportunities. That doesn't mean that you must be overly opportunistic and depart from your core mission. It's important that a business sticks to what its core purpose is, but new revenue opportunities just mean that you are finding a different way of servicing your market. Some people may go out and buy plants to make clothing masks, which it may make sense. But let's remember day 0 when all the supermarkets had stocked up on so much water. And then day 0 was cancelled, and all of a sudden water was being given away for free from supermarkets. So just be careful that you don't overinvest without forgetting business fundamentals. And another key agility point is stripping away your fixed costs. At this point, you need to be agile. And if 80 to 90% of your costs are fixed, and that might have worked in the previous economy, it won't work now because you're having to react very quickly. I've seen an example of a call center that they managed to get everyone to work from home. They carried on providing full service. And I suspect that they'll think twice about going back to a full rental agreement because their whole workforce was able to work from home, barring a few. And they needed minor changes such as data and so on. The fruits of an agile company are really societal benefits. We can protect and maintain livelihoods. If you're running a business, you need to see yourself as the captain of a ship. Your role is to keep that ship upright. Sometimes the changes that you need to make to that ship may affect some employees, but the key is to preserve that ship at all costs, because that way you can preserve the majority where possible. And being agile means you can serve customers according to their new needs, and you can contribute to society. So what's happened with all the funds that are out there, there's a new social compact where hopefully paying tax will be seen more as helping a fellow member of society, as opposed to money which is going to a black hole. One aspect that I want to touch a bit deeper on is how we work in a complex adaptive system. Now, a complex adaptive system is a system which means that you can't always predict what's going to happen. So I used the oil price example. What happened with oil was that at some point, because many economies have shut down, there wasn't enough storage space to store all the oil that was being produced. Now, that's the symptom of a complex adaptive system. No one could work out how much oil capacity was required to store the oil, because I don't think people needed to track that. Oil was being consumed as it was produced. And the challenges of such a system is that we don't know what feedback loops are going to be tipped over because of what's happened. When entire industries are shut down for 2 months, perhaps in the government's mind, they'll get to August and say you can now resume. But the challenge is that those businesses might have moved on. Their shareholders might have made other changes. The retailers might have decided to use their capacity in another way. And that's the beauty of human thinking. We always find ways to adapt. But that means that it becomes unpredictable for others in terms of understanding what may or may not happen. So there will be unpredictable and unintended consequences. Just because, for example, one is in a bank and you can trade fully, it's difficult to predict at what stage your major banking customers will stop doing business. And I'm just giving that as one example. So that means we need to live with the uncertainty. We can't make any assumptions, irrespective of where we are in the economy. And we just need to watch very closely to see what those developments are. In a complex system, it's important to allow solutions to emerge. More importantly than ever, we shouldn't be dictating to our customers what they need. We need to be listening a lot more. We need a very customer-centric approach to what we do. Yes, we had a bouquet of services that service those customers for years. And in CISA's example, our services have been very stable. They've had an active market. But now we're being forced more and more to look at what our customers' needs are, especially if I look at the different stages of the lockdown that are coming up. I just want to finish off by talking about how CISA is adapting and how we're applying these lessons that everyone is similarly applying. We don't profess to be experts. I looked back at my years of training and I couldn't find any course or module which covered any epidemic or anything like this. So for me personally, I'm learning as I go. There may well be experts that lived during the Great Depression and that have lessons, but yeah, a lot of this is new for us. As CISA, we've been looking at the market for pure digital services for fitness. And many of our members will have started making use of those applications, the online classes delivered through Zoom, Facebook, WhatsApp, and we've been having to adapt based on what our members can and cannot access. But we also are aware that there is a market for members who need to be assisted in new ways for old needs. And that's something that we're looking at very closely, especially as I saw with the president's announcement yesterday that people can now walk walk, run, and cycle. I think, yeah, walk, run, and cycle. We'll need to see what that means. And once we know what that means, we can find a way of assisting our members as we go through the different stages. We know that people have been locked down for a month, at least. Now let's say it takes 21 days to develop a new habit. So our customers have developed new habits. We need to understand what those habits are, and we need to then adapt to those habits. And some of those habits may be permanently different from the old habits. We've placed more focus on online methods like online education. We had 2 full classes who were doing certificates and diplomas prior to the lockdown. And within a few days, we were able to switch them to distance learning. And what we're doing now is to see how we can take our new models to corporates as well, which we are currently launching. In this COVID dilemma, it's more important than always to partner with employees, customers, and our boards to find solutions together. Previously, boards could just meet on a quarterly basis. We're at a stage where we provide updates to our board on a weekly basis. And I think it's the same for many companies. You can't plan that long term. And it's important that together with your management and your board, you're updating your forecast on a weekly basis, you're testing your scenarios, you're challenging your cost management. And after you challenge your cost management, you challenge your costs again, just to make sure that you've left nothing behind. And the scary part is that you still have to make decisions that factor the uncertainty. You may have to make decisions with incomplete information, but often that's better than not making any decision at all. Yeah, so in summary, that's our learnings in terms of how one can become more agile in this environment. It can be a very stressful time for everyone. I was just saying to Phatho that I feel like we've had to work even harder during this period than before. And it's part of the lesson of remote work. But yeah, we're still here. We find ways to adapt, and we hope to carry on that journey with all of you that are on this call today. On that note, I'll hand back to Phatho to carry on.
Thank you very much, Mandla and John. Some really valuable insights from both of you, and thank you for sharing your experience. At this point, I'd like to invite our participants to ask questions to any of the panelists. If you are joining us from Zoom, if you look at the bottom, you'll see a chat icon. And in this chat icon, you can type in your questions and we'll be able to address them. If you're joining us from Facebook, then you can just type in your questions there and we will get those directed to ourselves and our panelists will address those questions. Yesterday, the World Health Organization commended South Africa for acting swiftly and following scientific evidence to contain the virus. However, while a national lockdown is probably the most effective means to contain the spread of coronavirus, we know that the economic repercussions are such that it cannot be sustained indefinitely in our country. Government has confirmed, as John and both Mandla said, that from 1 May, we are going to begin a gradual and phased recovery of economic activity. And in this way, it's hoped that, yes, we will be able to save both lives and livelihoods. I'm going to kick off some questions and perhaps start with you, John. A question that has come up before during this period. Many banks and even financial advisors have offered clients, for instance, deferred payments or payment holidays on things like home loans, retirement annuity, and such. Do you have any specific advice in this regard? And I do understand that some of these are very personal, looking at the entire sort of dynamics of a person's portfolio, but any specific advice on this?
I think just with the caveat that I think it's relevant to each person. So, my strong advice to all of us is to use a bit of time that you have at hand now to pull up your bank statements and go through each and every expenditure item, that which is sort of the normal consumption, that which is debit orders, fixed costs and the like, and just to reassess and to see where one can cut or defer payments. So if you're talking about bank payments and bank loans, never more so than ever time in history have banks been amenable to some kind of deferred plan where it is on the capital repayments or the interest repayments. And now's the time to engage with them proactively as opposed to reactively. And the same thing with a lot of other sort of suppliers or your creditors. What you have to do is you've got to be proactive in this environment. You cannot wait to month end and then react, or wait until you get a sort of a letter or an email. When I made reference to medical aid adjustments or retirement funding adjustments or risk cover adjustments, one's got to be very careful, because at the moment everyone's saying, well, you can do this, you can defer a premium, you can do, there are consequences to it. In many cases, if you defer paying your life policy premiums, you may not be covered over this time period. Now, you know the risk that runs there. In the same vein on medical savings or medical premiums as well. So all I would suggest as a sort of a broad strategy, and I'm talking about sort of our lifestyle expenditure, the money that we spend to live on a day-to-day basis at home, engage, well, assess your set of financials, go through your expenditure and engage with the parties where you need to, where you want to make cuts or trims or defer payments to get yourself in a position to ride this out. The last point that I want to make just on that score, Phatho, is that this is not something that's going to disappear in the next month or two or three and everything's going to be, okay. One's got to be making some bold decisions now to see ourselves through the year that is 2020. So think with a slightly longer mindset than what would normally be the case.
Thank you for that, John. A comment from one of the participants, just to confirm to everyone that these slides will be made available. So we should have your email addresses. And if we don't, if you can send an email to info@cisa.com and request these slides, we will make sure that we send them to you. A question from Terry Strong to all of the panelists, and perhaps I'll start with you, Mandla. His comment really just being that so far, South Africa has experienced 75 deaths, which is relatively low, although of course we know that one death is one death too many. But the question really is, has the long-term damage to the South African economy and to our individual finances and lives been worth it? Mandla, let me start with you.
Yeah, thanks, Phatho. I think that's such a difficult question, and I'm just happy I'm not the South African president. We have made that call. So in healthcare, there's a measure called Quality-Adjusted Life Years that's normally used to see whether an intervention is worth it. And basically, it looks at the economic impact of an intervention and the number of life years that are added or subtracted to an individual because of that intervention. And this is economic years. At the moment, the stats will show that the suffering that we've had collectively is a lot greater than the consequences that Terry is mentioning, the 75 deaths. The big challenge though is that there is an unknown. We don't know how worse this can get. There's still a lot of untested assumptions in terms of would COVID-19 really spread drastically within communities? I don't think we've seen that yet, and we don't know yet if we released the lockdown, whether we'd have that dramatic spread that could lead to millions of lives. So all I can say is that it's an unknown. The government, obviously, their risk appetite was that they'd rather not lose any lives. Lives will be lost in terms of the other effects. People who are probably depressed from lockdown, people who've lost jobs, people who go hungry. And hopefully we can get more statistics about all those other impacts so that one can compare the different lives lost or preserved.
Thank you, Mandla. John, there is a second question for you, but do you have anything to add or expand to Mandla's insights there?
No, maybe just one or two things. I mean, I think the problem that this is, it's an enemy that we all acknowledge, but we can't see it. And what we equally don't fully understand is the word exponential. And when you look at the trajectory of infections and how exponential it can become, is that you're continuously weighing up the financial cost versus human cost. And I'm at this stage, we will see in time what the right decisions were or not. But at the moment, I think what we've just got to acknowledge, we've got to do as much as possible as we can to save lives, but not too much to destroy the economy. And it's this balancing act. And I've thought to myself when I was reading the levels of 1 to 5, the world that we're going into now is not the load shedding. We all know when they say level 1, 2, 3, all the way on load shedding, we're going to get level 1, 2, 3, 4, 5, 6, or 5 rather, to adapt to save as many lives as we can, but also save livelihoods at the same time.
Thank you, John. A last question and final question. I'm mindful of the time. Perhaps you, John, would now be a good time for offshore investments?
Okay. Can I? Okay. There are a couple of things that we need to think about here. It's not a simple, short answer, but I'm going to give a few things you've got to be very careful about. One of the things is the currency has blown out dramatically. So if you are considering moving rands to dollars or pounds or euros to a foreign currency, you're buying at a rate where the rand has experienced some significant weakness in the short term. I would expect to see some rand strength in time to come as things settle down. That doesn't take us away from the fact that we've been recently downgraded. The South African economy is going into a recession, but I think the risk off across the emerging world has been quite dramatic, and we've seen it in the rand. The market bottomed out in March, 24th of March of this year. So it was a significant plummet, unprecedented, from Valentine's Day to roughly around 24 March, where the markets across the world lost anywhere between 30 and 40% in hard currency, dollar, pounds. I'm talking stock markets, equities, and listed property. We've seen a bit of a relief bounce since then. So we've seen the market come back quite strongly in the month of April. And the question that is unknown to all of us, and this is the difficulty, is that we know that activity has been lost. We know that economic activity has been lost. We just don't know how much has been lost and whether we could recover some of that lost activity. I.e., when we all go back to business, can we make up lost sales that we haven't had? And so our view is at a team at the moment is that this market has rebounded probably a little bit too much and is now neutral in terms of where we are in the world situation. And so I wouldn't be overly aggressive. I would look at my long-term strategy. I would try and understand what my long-term strategy is. I would make sure that my short-term liquidity is covered and that I'm not taking any unnecessary risks. And then I would look to phase capital in to the right investments with the right time frame, without trying to call a bottom, a top, the next 6 months, 12 months. And that is a very general answer, but it's the answer that our team would give to every single client, based on their set of circumstances.
Thank you very much, John. So again, thank you to both of the presenters today, Mandla and John. It's 3 o'clock on the dot, and I'm going to close this session by quoting President Cyril Ramaphosa in his address last night. He said to us, "There is no person who doesn't want to return to work. There is no company that does not want to reopen. Yet we are called upon at some point in our lives to make great sacrifices for our own future and for the future of others. There are times when we must endure hardship and difficulty so that we can enjoy freedom and prosperity into the future. We must not give up now." Thank you to all the participants on Zoom and on Facebook for joining us this afternoon. Again, thank you to Mandla and John Kennedy for joining us. We say farewell to you, stay home, stay healthy, and stay hopeful. See you next week, where we'll delve into issues related to mental health. We'll be joined by our resident sports psychologist, Clinton Galwiger, and an executive business coach, Gilbert Dennis, to take us through issues related to personal resilience and leading through change. Stay safe, stay well, and goodbye. Thank you very much.